All right. Good afternoon, everyone. Welcome to the Fed Live. Is this thing working? Doesn't look like it. There we go. Now it ought to be working. Okay. Sorry about that. Little mic difficulties. Thoughts on Exxon Mobil and GLD? I think that GLD is probably going to come down after this first release at 2 o'clock, and then usually what happens is that it reverses that move afterwards. So we'll see it for gold. My assumption is that they're going to go higher with the interest rates. The dollar is going to go higher, which should send gold down. Could also amplify the fears of recession, which would be positive for gold. But my assumption is that dollar up, gold should come down with it. But the release is coming out in 1 minute. I will link this so y'all can refresh the page. Hopefully the servers don't crash on the Fed's website. That would be wild. But yeah, we got, let's see, 30 more seconds till it comes out. And keep SPY on the side over here. Currently trading at 398.71. So flat, just like I expected, between 398 and 399. Did move a little bit outside of that range to 399.88 and down to 397.42. But this is where you're going to get the big move upon this release. All right. Should be coming out any second. There it is. Projection materials. So you want to scroll down. I'll copy and paste this link. And you want to look at the future projections for the federal funds rate. So looking at this, the median for 2023 is 5.1. Still expected to be in a range between 5.1 to 5.6. So they kept their previous guidance. So this means that the rates, treasury rate, should go up on this. Let's see, the dollar should go up with it. Not the reaction we're seeing yet. Let's see, the dollar is actually coming down at the moment. But they kept the 5.1 to 5.6, so this is unchanged from the last one. Let's check out the dot plot. See where they're standing. So for 2023, this basically looks identical to where it was before. And then for 2024, they're expecting to cut rates to 3.9. Well, I guess such a wide range is not really a cut. But the range is expected to be 3.9 to 5.1. And then the long-term range, so past 3 years out, is expected to be 2.4 to 2.6. So if we look at the previous report, let's see, FOMC calendar. So with the dollar moving down like this, I think that would be recessionary. So gold is reacting up to that. SPY is reacting up to that, surprisingly. Currently trading at 400, up 0.25%. And usually whenever Jerome Powell starts speaking, it has the inverse to that. So maybe once we reach that 400 and Powell starts to speak, you'll see the reverse back down. I think with them keeping the interest rates high up there, that treasury rates would rebound to where they were previously. This would mean the 10-year would probably go to like 3.8, currently at 3.53. So I'd say the best short position would probably be the Qs, the high value tech stocks. But yeah, this is basically unchanged from the last reading. Let me see. From December of 2022, if we compare and contrast the two of them. For 2023, the median was 5.1, 5.1 to 5.4. So the high end of the range actually went up, but the median stayed the same. And then the long range, 2.3 to 3.3, actually went up to 2.3 to 3.6. So there's members on the Fed that are more hawkish for the long term. Looks like one member is extremely hawkish for 2025, keeping rates above 5.5%. Probably either Kashkari or Bullard would be my assumption, would be one of those two. And then for the long term, most of them are expecting 2.5% funds rate past 3 years out. So higher rates for longer is what this is telling us. So we'll see the adjustment to the, let's see, FOMC watch tool, the Fed futures. For December, currently the Fed futures expect them to cut 50 basis points from where they're at right now. So this is going to adjust up since the Fed has given clear guidance that they're going to raise rates higher. But right now you're just seeing a flunk in the treasuries, interesting enough. Could take time to play out. Yeah, Dixie ended up diving. Indeed, the Dixie ended up coming down, but I think that probably going to reverse the action after Fed Chair Powell speaks, because this is a clear indication that they're not letting their foot off the brake when it comes to interest rates and going higher with them. And I think he will clarify that, and probably he's going to say something along the lines of what Lagarde said and say, if we need to, we'll back up the banking system with liquidity and keep raising interest rates. So that'll be their new tool that they're adding to their tool set in order to, get the soft landing and get rid of inflation. It's probably not going to work out too well. You're probably just delaying the inevitable. You're going to get a recession either way, most likely, as banks end up tightening their lending standards. But we'll have to see. SPY's up 0.6%. TLT went up, but then ended up coming back down to where it was before. Let's see. Yeah, so TLT is going down. That means that TNX should be going up the long end of the Treasury yield. Currently still at 3.52, but my guess is this is probably going to be, in the next couple of weeks, back up to 3.7 to 4%. In the next few weeks, which should weigh negatively on gold. Gold is popping right now, though. Currently trading at 182. I think I gave myself an extra week until the expiration for that. So, should be okay with that. Do I think we'll see a turn after Powell? Most likely. That's usually what happens. You usually get one direction whenever the rate decision is made, and then the opposite direction whenever Powell starts speaking. And I think he's going to make it very clear that they're honing in on inflation, which should send rates up, which should end in QQQ especially coming down, but the overall market would come down with that most likely. U.S. banking system is sound and resilient, as if we've heard that a million times this week with Yellen saying that at her little press release that she had. Fed funds GDP expects 0.4 to 0.5% for their December projection. So this is a GDP, something that we didn't really mention too much. We're just focused on the rates. So they also give the GDP projection, and they also give the inflation projection for the end of the year as well. So they're expecting inflation to be 3.3% at the end of this year, based on PCE inflation, and then core PCE they're expecting at 3.6%. So they're expecting core to actually be stickier than regular PCE, interesting enough. But that's also usually what happens whenever you go into a recession. You get a reduced amount of demand for oil, just because there's less going on in the economy, which ends up in demand for oil coming down. So that's probably why they expect PCE inflation, which includes energy and includes food prices, to come down more than core PCE, which they expect to be a little bit stickier at 3.6% versus 3.3%. And then for the unemployment rate, they're expecting it to go from 3.6% at the latest rating to 4.5%, so a 0.9% uptick in the unemployment rate between now and the end of the year, which I think that would be inconsistent with what the Congress hearing would. I forget who it was. I think it was the guy from Kentucky was saying that for every 2% that you drop in inflation, you get about a 3.5% increase for the unemployment rate. So I think that they're giving pretty rosy projections for the unemployment rate at 4.5% by the end of the year. Let's see, what is the latest core PCE? As a percentage is what we're looking for. Year over year. Last one was 4.7%. So based on history, bringing that down to 3.6% or about 1%, we would see roughly a 1.75% or almost a 2% increase in the unemployment rate from 3.6 to probably 5.6 instead of the 4.5 that they're expecting. But yeah, we're seeing start to a pullback right now. SPY is trading at 400 flat. We went up to 401.70, and then for SPX, this ended up going to 40.66, and now pulling back to 40.47.75. Ten-year is basically unchanged at this point, but TLT, the 20-year Treasury bond ETF, is pulled back from, what was it, like 105.80 or 106 to currently 105.45. So I think this is probably the right move. You'll see a sell-off in Treasuries, expecting higher yields. All right, we got 55% saying that they expect the markets to be green and 45% saying red today. Let's watch this play out. It'll be interesting for sure. SPY just fell below 400 right now. I wonder if we'll get a sell-off right before Fed Chair Powell starts speaking, because the trend has always been they reverse the direction after Powell starts speaking, so it might start selling off in anticipation of that. Fed says tighter credit will weigh on economic activity. I would say that's a fair assessment. You're going to see tighter lending standards, which is going to decrease the amount of money that's being borrowed to boost the economy. The federal funds rate, traders see a 62% chance of 25 basis points in May. So now you're not going to get that pause. That's what they're telling us now. So if we go back to the FOMC watch tool, the pause is now off the table for May. Let's see. Yeah, so right now we're at 4.75 to 5% after this 25 basis point rate hike. And now for May, they're expecting rates to go to 5.0 to 5.25. And then for June, so we're readjusting here, they're expecting a cut still for June, interesting enough. So they're expecting it to go to 5% down to 4.75%. Pulling back now to 3.99, giving up all those gains that we just had. You're going to see a lot of volatility around this. For sure, for sure. VIX is 21. We're back to 21 on the VIX. Let's see. We ended up coming down, I think, to 2050, 2025. And now we're seeing a rebound of the VIX. I would watch the VVIX. That'll be interesting. Because the VVIX, or the volatility of the VIX, is still elevated as hell. Currently at 99.50, up from previously 74.50. So I think that the VVIX, the volatility of the VIX index, is probably going to go higher. My guess, probably going to come back to where we were the last couple of weeks to, say, 110, 115. I don't know if we'll reach a new high for the VVIX, but I do think that we're going to see a lot of volatility for the volatility index. Volatilityception. Options are on a roller coaster. Yeah, absolutely. Absolutely. Still got all my positions that I had previously open. Got about 15 minutes until Powell starts to speak. But yeah, my best guess, he's going to say something along the lines of, we're going to keep raising rates until inflation is done. I think the usual wording he says is, we will keep at it until the job is done. Something like that. And then he'll say something along the lines of, the banking sector is fine, like what they were saying before. But if necessary, we can provide liquidity for the banks if there is systemic risk. It's probably not the exact words that he'll say, but something along those lines would be the most likely outcome. Let's check SPY on the 5-minute chart. 399.25. So basically breaking even for today. We got that 399.03 support level, and we ended up topping at 401.70. I think there's an important resistance at that 40.65 level for SPX, so that might have been why we saw that pop to 40.66 and then dropped immediately after. Let's see if we can find some levels from this. 40.65. There's no real gaps in the chart or anything that would indicate a 40.65 pivot, but yeah, that's exactly where we pivoted, though. Interesting enough. Oh, that's the words that he's going to say. The U.S. banking system is sound and resilient. Which is the reason why they ended up going higher with the interest rates, in my opinion. What is your opinion on what we'll see in the stock market if interest rates rise? I think that you're going to see a correction for tech stocks, especially. I think that's where you're going to see the major correction. So for NVIDIA, I would expect to come down from its highs at 270 right now. And then QQQ, I would expect that to come down from its highs at around 310 right now. That's where I think the best short positions would be in the high growth tech names. Yeah, no problem, Josie. So we're basically trading where we were yesterday. At the end of the day, a little bit higher than we were. 399.64. A lot of volume coming in to be expected with the Fed release. Fed leaves medium longer run forecast for PCE, real GDP, and federal funds rate unchanged from their December projections. Exactly what we talked about. So you should see the Fed futures and interest rates adjusting accordingly. Let's see if this has changed at all. All right. I don't know who's betting on 50 basis points here. A 1.1% chance when it already came out. That's kind of wacky, but let's see. For May, still expected to 550 to 525, so no pause for May. And then possibly a pause or a cut for June is what the Fed futures are still saying. And another another cut or a pause for July is what it's saying right now. I think the Fed has made it pretty clear that they're going to stick with the higher interest rates, though. I think that pausing cutting is off the table until inflation is back down to their goal at 2%. Or, I wouldn't say that, actually. Until it reaches probably, below 4 or 3%. And then they'll start pausing, would be my guess. But yeah, this went exactly as I planned. SPY not really reacting as I had planned, but them keeping the federal funds rate the same for the end of the year is exactly what I expected. So not too shocking here. Pretty plain vanilla. And then the 25 basis point rate hike. I think they probably should have went with 50. But because of the banking issues for the last couple of weeks, I think that's probably what ended up stopping that. I think if we didn't get that banking meltdown the last couple of weeks, they probably would have went with 50. Let's see, the VIX is down to 2069. Where did the charts go? There we go. VIX is what I would keep my eye on. Currently at 2068. It went all the way up to 21 and pulled right on back, but I think this is probably going to rebound after Powell starts to speak, in my guess. Not really seeing how the markets could see this as bullish, but Fed leaves the median longer term forecast, real GDP and everything the same. We already read that. Another swing at inflation with second consecutive 25 basis point rate hike. So another 25 basis points from last month. Let's see if there's any other headlines. PCE inflation forecast was revised up actually from 3.1 to 3.3% for regular PCE. GDP changed 0.4% to 0.5%. So they're expecting the GDP to actually go up by the end of the year. I think that's not going to be the case, but I would expect GDP to probably contract in the last couple of quarters. Probably the last quarter of the year would be my guess. You're probably going to get a negative GDP reading. Unless they're doing it for 2023 overall. That could actually be the case. More interest rate hikes, less inflation. Would be bullish. You would think so. But with tech really trading up based on expecting interest rate cuts, I don't think that it's going to be bullish. Higher interest rates make the tech valuations that are so high less and less attractive. Sorry for the off topic. Why do I drink from a large glass jug? Oh, this is a mason jar. It's just a regular size mason jar. Coffee. And then I have my water here. Mason jars are the most cost-effective glass there are. They're so dirt cheap. And they're nice little containers too. But yeah, the dollar index really coming down. So my guess is that's probably recession fears. Let's see what oil is doing. Oil would be down with that, though. That's the problem here. The dollar going down in anticipation of a recession would also mean that oil would come down, but it's actually having the reverse effect. Very, very strange. So either oil is lying or the dollar is lying. One of these two. What is Bitcoin up to? Let's see. BTC. Go to the Robinhood. Start closing out of some positions once Powell starts to speak. Bitcoin's trading basically at the same price that it's been though. 28,500. Not really changed much. Before the release, it was at 28,700. So it is pulling back a little bit, but not really changed much. For Bitcoin, at least, you'd expect a huge pump or a huge dump. But you're not really seeing much trading action. You're seeing a lot of trading action, but you're not seeing a lot of movement after this Fed release so far. We're up 0.18 or 0.2% for SPY. Still catching some support at 399.03. And then Powell is going to be speaking in 3 more minutes. So he's definitely going to get us out of this little range that we're in. From 399 to 400. So that's our new range, is 399 to 400. So we went from a range of 398 to 399 to 399 to 400. That's really wild that it would stay in such a small range. But let's pull up old Powell. YouTube. He'll be speaking in 2 minutes. Powell live. Oh, they better not have any music for copyright. I change my... Yep, there we go. Sound output. It's the multi-output device. All right. Let's see. All right, the audio input. Let's make sure I have everything right. Okay, everything should be good. Let me make sure. All right, we should be good for whenever he starts to speak. In 1 more minute. All right, we should be good for whenever he starts to speak. All right, we're trading at $400 even right before he speaks. Okay. Should be coming on any minute now. Move this to picture in picture. Get rid of my camera. There we go. We're ready for you, Mr. Powell.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SEP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So,
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
no, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first 5 weeks of the intermeeting period, pointed to stronger inflation and a stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. it is clear to your last question. It's clear that we do need to strengthen supervision and regulation, and I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
Question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
You know, if you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you. Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed, do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
It depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, in particular immediate attention. And I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question, and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, if I did, I wouldn't share them, because I really, this review's going on. And I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank. And under again, Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance.
Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were
okay.
to tighten enough, if that would prompt a rate cut.
So, financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and so that's all I have to say. So, thank you very much.
Going, huh? All right, there we go. That was uncomfortable towards the end. He did not seem to, or the press did not seem to like him very much at all towards the end. They were really pounding on the unemployment, kind of similar to what Warren was picking at him at the last. Sorry about that. Basically picking at him just like Warren was whenever he was testifying in front of Congress. So SPY ended up moving down to 397.50 right now, from 402.50. And I think the main comment that came out of this was that he thinks that the SVB, the Silicon Valley Bank, was an isolated event, which I've been kind of saying that just because they weren't, hedging their inflation rate risk with interest rate swaps, they were basically an isolated incident. And you did have a couple other banks, going belly up, like Signature Bank, which had very similar issues. So that's really why you got the sell-off. And then the comments about unemployment going up is really where he started to get uncomfortable, and we ended up breaking a new low, but we are rebounding a little bit after he finished that, and he kind of just seemed to have stormed off the stage a little bit. It was very, very strange. But yeah, we're trading at 397.50. The VIX actually pulled back. It was trading at 21.50, almost 22, but now down to 20.87. So we'll see how this plays out for the end of the day. We got about 45 minutes until the market closes. So let's keep monitoring SPY. So I was watching the 10-year Treasury rate. That ended up going up after he made that comment about SVB being an isolated event. The dollar ended up going up with that in that same 10-15 minute time frame. The dollar still has a long way to go back to where it was before the Fed release, but I do think that we would probably make it back up there in the next couple of days, in my best guess. But right now, SPY is currently trading at 398.30, so we ended up reclaiming the lows of the day. We might end up testing 399 again, but my guess is we probably head down after those comments that he had. Yeah. Well, the thing is, if he doesn't know what's going to happen and he's going to act accordingly, he's going to react too late. And that's the problem with the Fed, is that they're not proactive, they are reactive. And they're only going to react with lower interest rates when something ends up blowing up. That's always what happens. The boom and the bust created by the Fed. But yeah, let's check out the Fed futures, see if those changed at all. My guess is they probably ended up going up for the end of the year, but we'll check in. Let me get rid of this. All right, so we're looking at, for May, another 25. Actually, no, they're expecting a pause for May. We're at 4.75 to 5% right now already, right? We just did a 25 basis point rate hike. So there's about a 53% chance that we pause, and then a 46% chance. So about a 50-50 chance between a pause and a rate hike. And then for July, we're expected to stay where we're at right now. And then if you go to the end of the year, they're still expecting 50 basis points worth of cuts by the end of the year, even though the Fed has said that they're going to go to 5.1% for the peak rate at the end of the year. So I think that this is probably going to adjust over the next couple of days, given his comments about SVB being an isolated incident. So you're going to see probably treasury rates going up. You're going to see treasuries themselves likely coming down, but initially we saw TLT going up with this, and now it's kind of just trading flat. So we'll probably see more decisive price action over the next couple of days, I think. Gold is pulling back a little bit from its highs. It was up to 184, Jesus Christ, down to 182.50. My guess is gold probably pulls back to 180 in the next couple of days with the dollar rising and rates rising. But yeah, SPY currently trading at 397.97, 398. So at those daily lows right before the Fed meeting. So we'll see if we're closing above or below that. Got about 40 minutes left. U.S. Treasury Secretary Yellen says, I am focused on stabilizing the banking system and improving public confidence for it. Powell says we need to know the extent and duration of the tightening and how that works its way into the economy over time. Financial conditions have tightened probably more than what traditional indices say. Other measures of banking, lending, etc. show some more tightening. Question for us is the extent and duration of financial conditions tightening. Yellen is speaking right now. She's speaking right after Powell too. That's interesting. Yellen says we can debate in the future whether to raise the FDIC insurance above the 250 mark. That's probably going to be up to Congress, I think. But yeah, we are basically trading flat. But yeah, we had a very, very volatile time. Up to 402.50, down to 395.75, and back up to 399.64. Didn't expect today to be so flat, yeah. Yeah, the VIX is definitely not going to like this. Definitely not going to like the markets trading flat today, but I think next couple of days will be pretty volatile. But volatility does work in both directions, so be prepared for that too. So if SPY goes up, VIX would come down with it. Oil is trading up since the dollar is coming down. Gold is up with the dollar down. QQQ, kind of just seeing the same price action that we're seeing for SPY. Just amplified. Still up 0.75% today. And then IWM is the one that's leading the way down, 0.7% at the moment, off of its highs from yesterday, which was 177 to 178. I think by this Friday, you're probably going to get re-amplified fears of more bank runs. Seems like every single weekend after the SVB chaos, we're wondering which bank is going to go belly up. What are the banks up to right now, though? KRE is currently down 3.3%, down to 45, or down to 44.50. And then XLF, the big banking ETF, is currently trading at 32, only down 0.6%. So we're not really seeing too much volatility besides KRE selling off 3.5%. But this one's been volatile. Very volatile in the last couple of weeks since the Silicon Valley Bank meltdown. But yeah, these are some wicked, wicked candles for sure. What is our poll saying? 52% green, 48% red. All right, we'll see who is right on this. We got 107 votes. We got a pretty big poll. Very nice. My guess is we ended the day below the daily low at 397.37, but let's wait and see. QQQ is pulling back. It was up 0.75. Now it's up only 0.6. So I think tech is probably going to get hurt the worst with these higher interest rates. So a call credit spread or a put debit spread would probably be the best trade to take on, under the assumption that rates are going to keep going higher. The dollar should keep going higher with it. Should see a pullback in gold too, but not seeing it yet. Because you're kind of getting a mixture of recession fears and the higher interest rates. So whenever you go into a recession, typically gold tends to outperform. So it's kind of a back and forth game, it seems like, with gold. Could even do like an iron condor for GLD. That might not be a bad idea. All right, we're going to retest that 397.37 mark again, it seems like. I think IWM is probably going to be the leader here. Usually IWM is the leader for if we are going up or going down. And with IWM down 1.2%, I think that the markets are going to come down with it. AMD and NVIDIA both currently up about 4%. Are you okay? Yeah. Okay. Nvidia still trading up, 4% today at 272. That's crazy. I think Nvidia could probably fall to about, I would say 265 pretty easily the next couple of days. I would probably set the expiration date for the 31st just to give yourself enough time in case the markets act irrationally the next couple of days too. That's always possible. And then AMD, like you said, is up also 5% today, trading at that 100 handle, $100.41. What if we end up trading flat? What if we are just at 0%? That would be wild. Everybody in the poll is going to be wrong if we trade at 0%. Still got about 30 minutes though, so still a lot of time for this volatility to play out. So Yellen is basically saying what Powell was saying in his speech. SVB was an unusual bank due to its business model, interest rate risk, and high percentage of uninsured deposits. I would say that's an accurate assessment. So I wonder if that will pull down the markets like when Powell said it. I wonder if it'll have the same reaction to that. That was just a few minutes ago. $398.90. Yeah, we are just dead flat right now. Crazy, crazy market. This is going to kill all the VIXy holders and VIX calls. Shame, shame. Opened an iron butterfly yesterday and closed it at 1100. Jesus Christ. Chickened out. Oh, man. Damn. That sucks. That sucks big time. Yeah, an iron butterfly, assuming like 398, 399 today, would have been chef's kiss. And that was my assumption before the Fed meeting, is that we would trade between 398 and 399. And we basically got that, but I didn't want to take the position because of the rising implied volatility would have inflated the contract value and wouldn't have been profitable. But if you waited till now to close out of that, you would have made a real good profit on an iron butterfly or an iron condor, assuming SPY would be 398, 399 or so. Powell is 70? Are you kidding me? No way. I always thought Powell was like 60s. He's 70 years old. He's a good-looking old man. For 70 years old, he looks pretty damn good. And Janet Yellen is 76. Janet Yellen looks like she's 90. They should both be retired and collecting Social Security. Yeah, the government is basically a retirement home. Whether it's the White House or Congress, all of them are just way ridiculously old. Even Feinstein is like 90. She's literally 90 years old, and she's just now retiring. That's ridiculous. Daddy Powell has a skincare premium products. Yeah, that's funny. Just opened a bear call spread for SPY 418 to 420. 421 expiration. It's a bit far out in expiration, but I think the overall assumption is pretty good. I would probably shorten the expiration, personally. I don't like doing credit spreads that far out. I'd rather collect the credit a lot quicker. All right, we're down 0.25%. We're testing that low again, 397.61, and bouncing right back off of it. This is a trader's market for sure. Let's see. IWM is down 1.3%, so not really changed much. QQQ is almost a break even. I think that's probably going to be the indicator to watch whether QQQ ends up slipping red today or not. That's probably going to determine whether we're bullish or bearish going into the end of the week. Because QQQ has just been holding up like no other for the last couple weeks since the SVB meltdown. I mean, it's up from, 298 to 310. So I think that's probably going to give out. And once that gives out, that's when we'll start to be bearish. All right, we're down to the new low, or we're down to below the lows at 397.37. So we'll see if we go down to a new daily low, which would be below 394, 395.75. GME is still up 40%. Jesus Christ. Yeah, they ended up rallying like 30% after their earnings. Still up 37%. We're basically having a replay of January, February of 2021, where the markets crashed like hell, but GME ended up going up a shit ton. Got about 25 minutes till market close. The poll is 50-50. Damn. Y'all are right split. You're just going to see some wicked candles, especially at the end of the day, I think. These last 25 minutes are going to be chaotic, I think. The volume is kind of dying off, though. Interesting enough. But I guess everybody was tuned into the FOMC, so that's why you got so much more trading volume. All this price action, though, is just killing the VIX right now. That's what sucks about it. The VIX is still trading at 21, and we've had all of this back and forth. All right, QQQ is in the red now. So if we get a sell-off, I think this would be it. All right, 396.50. Let's head on over to the puts that I bought. UVIXI is just so disappointing, though. But, I mean, you only had like 2 hours from the Fed release until the end of the day, so you couldn't really expect a major increase for the VIX, but it is up from lows of like $20.50 or so. Or $19.94 was the low today, up to 21, so 10% increase for the VIX. And the VVIX, the volatility of the VIX index is still trading at 98. Again, I still think this one could probably go up to 110. But you can't trade the VVIX, unfortunately. I wish you could trade the VVIX. That would have been really profitable the last couple of weeks. Even more profitable than trading the VIX itself. Nike is down 3.5% today, but my assumption was that it would come down to 115, so I'm still negative on Nike. And then Chewy, I'm still up on Chewy by $9. I think I want to close out on Chewy. With QQQ coming down right now, I think that Chewy is just too risky to hold. Even if they do have a good earnings report, I don't know if their stock will hold. Right now, it's trading at 38.38. I'm assuming that it'll stay above 36. So it's only like a $2 drop for a $38 stock. So I think best idea is to get out of that trade while I'm, marginally ahead with $9 of profit. Let's see, I opened 3 of them at 31. Oh God, getting out of this might be a mess with the bid-ask spread. All right, I'll close them at 29. And if I have to, I'll go to 31 and just break even for it. All right, got a 2-factor authenticate. Love that. All right. Come on now. Yes, we got filled at 29. A whopping $6 of profit there. That's okay. I'd rather take the $6 of profit than risk the $200 loss. We're still 50-50 on green-red today. I guess we have so many votes. If anybody does vote, it doesn't really change it much. All right, closing options alert. Options alert. Premium. Just took profits for the Chewy put credit spread expiring, I think this Friday. 324. Let's see. Yeah, 324, 33, 34 strike prices, or 35, 36 strike prices. And I got out at 29 each. Didn't want to hold it into the report after hours just because the QQQ is losing ground right now, which is going to weigh negatively on Chewy. Even if they have a good earnings report, it's not really going to have much impact. Yeah, we got a solid rejection at 399. Volatility is just not really doing its thing. We're down 0.5%. coin is finally down after the last big rally. Yeah, Bitcoin ended up really pulling back from this. Let's see, BTC down to 27.2 from the highs at 28.6. So Bitcoin really felt the pain. And that was basically as soon as the Fed release came out, they were sinking ever since. Why am I interested in Chewy in the first place? The reason why I wanted to trade Chewy was their earnings report today after hours. All right, looks like we're just going to bounce around here. QQQ is just really toying around with that break even. It's up or down like 0.1%. Such a tight range. IWM is down 1.6%, so this was only down 1.3% earlier, so I think this is probably going to lead the markets down. Usually IWM is the leader because it's risk on or risk off, since Russell 2000 is the small cap, and small caps are more risky than the large companies that have more capital to work with. I think we're going to stay below 397.38. That's my best guess. Now, if we go to new lows, that might be a shocker. If we go below 395.68, that would actually be pretty surprising to me. I don't think we'll reach that. But I do think that we're going to close below 397.60 or so. All right, here we go. Might retest the lows. Maybe. The put debit spreads that I bought, assuming 395, 394 tomorrow, are basically break even. Yeah, 323 expiration. So I still have another day for this option. I'm surprised that they're not a higher value. They're trading at 35 when SPY is at 396 right now. All right, we slipped for QQQ. So new lows it is. New daily low. I'm looking at that 395.25 mark. Maybe you get a bounce on that, or you get a bounce on this daily low. We'll see. QQQ outperforms SPY after the Fed decision. It's been outperforming, but I think now it's going to start underperforming. With the higher interest rates, it seems inevitable. Dollar is rebounding a little bit. Still has a long way to get back up to where it was, though. But SPY currently at 396. Got 15 minutes. And we did break the new daily low, but we'll see if we continue past. I'm up $8 for the put debit spreads that I opened. Really shocking that they're trading so cheap. I would want to buy more, but I already spent a good 36 times 8, still, I'd spend like 300 for it, so. Not really worth putting more into it, in my opinion. VIX is back up to 2120. Bitcoin is just getting hammered. 4.5% down today. I wish you could buy some volatility for Bitcoin. That would have been really profitable. I wonder if they have a VIX for Bitcoin. That would be interesting. But yeah, recovering a little bit. The put debit spreads I got are currently up by 40, down to 395. So we just broke that 395.25 mark. We'll see if we sink it down to 394. I don't think we'll get to 394 in the next 10 minutes. These are going for 39. I bought them at 36. 8 of them. Let's see. Debating on whether to take profits now or wait till tomorrow. QQQ is down 0.5% now. VIX is breaking even. And the dollar is still kind of just trading flat. Gold is still sticking though. That's what's odd about the dollar. But I guess the dollar coming down means that gold would go up systematically. You have IWM put credit spread at 771. Oh, I think you mean 171, 170. Put credit spread at 170. Let's see. It's currently at 173. 170 is pretty far away. So you could be okay with that. But if that downtrend continues tomorrow, IWM is going to feel the pain the most. So you're seeing down 2.1% today. You could see something very similar tomorrow to where it's down another 1.5 or 2%. So that would lead it to 0.985 times 173 it's trading at right now. That would lead it down to your 170 mark that you're looking for. So if you expect the markets to recover tomorrow and Friday, you could hold it, but my guess probably not. Yeah, depends on your expiry too. Like if your expiry is this Friday, I would probably want to get out now. But if your expiry is a little bit longer, say for like next week, early next week, something like that, you might be able to hold that and you might be okay. But SPY is at 395.24. We hit 395 flat and ended up bouncing on that. All right, these are trading for 42 apiece. Now we're trading in the 394s. These really should be going for more. I feel like they should be going for like 50 apiece. But I guess the market's really expect a U-turn tomorrow. We'll see. We shall see. Red is definitely winning. Let's see. Yeah, 50%. We still have 50-50 split. Interesting enough. 119 votes. Go red team. Right. It was looking like we were going to trade flat. That would have been ridiculous if SPY ended up trading flat today. But yeah, we're down 1% now. In 2 hours, that's a pretty good move for 2 hours. 394.25. So we're getting close to that 394 mark. These really should be going for more. Damn. I feel like I'm getting robbed. Just got an alert that they're up by 20%. As if I don't know Robinhood. Now QQQ is down almost 1%. So now QQQ is catching up to SPY on the downside. That's what I would expect. But there's still like a 0.3% difference between them. The VIX is back up to 22. Really shocking that it's not above it, but it is what it is. Give it a couple days. I think it'll do it. I think the VIX will pop. All right, we're up 120 now. Debating on closing these for 60 apiece, but I just feel like I'm getting shorted right now. They're going for 55 even at the ask when they should be going for more than 60. Unless we end up recovering overnight, which that's possible, but we'll watch. I could always close part of it too. Might not be a bad idea. 300 risk on the table. I could reduce it down to 200 risk by selling 2 of them and holding on to 6. I just feel like selling them for 50 is just too cheap though. I feel like I'm getting shortchanged here. All right, there we go. Now it's trading for 51. Still don't think 51 is enough, but I'll take it just to decrease my risk. So I sold 2 of them out of 8. Still holding on to the other 6. Hopefully I can post this in a decent time. Closing options alerts. Premium just closed 2 of 8 SPY put debit spreads expiring tomorrow, which is the 23rd at 52 each. Strike prices that I chose were 394, 395. And now we're down to 393 for SPY. Down 1%, 1.1% for QQQ. IWM down 2.5% now. Yikes. Very muddy market. But yeah, I wouldn't be too surprised if we gave up all of our gains for the last couple of days by tomorrow, down to like 391. Which is only another like 0.5%, so that's not really calling for much. UVixie is recovering to 550 now. What made SPY go from 397 to 393? Any news? Oh, just the FOMC. No big deal. the biggest news that we were waiting for all month. Any news? What kind of question is that? All right, we're at 550 for you, Vixie, and still down for this position, but yeah, I think VIX is probably going to pop here. Especially if we get more systemic risk, bank run fears. That's probably what's going to kick us off, but I don't know if we're really going to get that. Again, I think that SVB, Silicon Valley Bank, was an isolated incident. Very, my comments are very similar to Powell. To where you might not see any more, but there was a lot of risk taking whenever interest rates were at so low for so long. I think that the Fed kind of engineered all of this with their zero interest rate policy. Look like we're going to be neutral until tomorrow. Oh yeah, for sure. Tomorrow's just going to be a flat day. Watch tomorrow actually be flat. That would be the funniest shit. Let's see. Let me check in on the put debit spreads that I still got. They're going for 54 now. Well, they're a little bit more reasonable. I still think that they should be trading for more than 60, but markets don't want to give me that. That's okay. I'll just wait it out. I will wait it out. That's fine. I got patience. Down 1.5% today. Q's is down 1.2. IWM down 2.7. In a matter of only 2 hours too. That's a pretty rough sell-off. But this was like the most anticipated. I mean, I say that, but every single Fed meeting is the most anticipated until the next one. So we'll see for the, May meeting or something like that. It's going to be the most anticipated again. But yeah, that's all I got for y'all today. Markets are about to close off. The bell's about to ring. My ear's off, but there we go. Close at 392.11. So I will catch y'all tomorrow at 9:30. See everybody. Okay.